the price that should not exist. A silver price of $117 per ounce is not a statistic. It is not a headline. It is a diagnostic reading. In normal conditions, commodity prices move within ranges that reflect production costs, inventory levels, industrial demand, and marginal changes in investor positioning. Even in periods of stress, they tend to respect the underlying structure of the markets that support them. A sudden move to $117 does not belong to that category. It does not describe a tight market. It describes a stressed system. Silver occupies a peculiar position in the global economic architecture. It is simultaneously an industrial input, a monetary metal, and a financial trading instrument. Each of these roles is governed by a different logic. Industrial demand is slow-moving and cost-sensitive. Monetary demand is cyclical and confidence-driven. Financial demand is fast, leveraged, and dominated by derivatives. Under stable conditions, these three layers coexist with manageable tension. Under stress, they begin to contradict each other. Historically, silver has produced dramatic price episodes. In 1980, it was driven by an attempted corner of the market and an inflationary backdrop. In 2011, it was driven by post-crisis monetary expansion and speculative enthusiasm. In both cases, the market was smaller, less interconnected, and far less embedded in the modern derivatives ecosystem. Today's silver market is not merely larger, it is more financialized, more leveraged, and more tightly coupled to the broader liquidity structure of the global system. That distinction matters. In a financialized market, prices do not move only because physical conditions change. They move because balance sheets shift, collateral values are questioned, and leverage is either expanded or withdrawn. When a price moves vertically, it is usually not because supply and demand have slowly discovered a new equilibrium. It is because something in the financial structure has failed to clear smoothly. A price of $117 implies one of two things, and possibly both at the same time. Either the physical silver market has become so constrained that normal price discovery no longer functions, or the paper market that dominates trading volume has lost its internal stability. In the first case, it would suggest an acute and visible shortage affecting industrial users, mints, and refiners. In the second, it would suggest a financial event, forced covering, margin cascades, or a sudden withdrawal of liquidity from one side of the trade. What it cannot represent is a calm, orderly repricing. Silver's production, cost structure, even accounting for energy, labor, and declining ore grades, does not naturally map to a three-digit price in a short time frame. Industrial users do not suddenly become indifferent to cost at that level. Substitution, demand destruction, and inventory liquidation begin long before such a price can be sustained. This is why the number itself is revealing. It signals not a new balance, but a moment of imbalance. In modern markets, the first place such imbalances appear is not in warehouses or factories. They appear on trading screens. The silver price that the world watches is primarily formed in paper markets, futures contracts, options, exchange-traded funds, and unallocated accounts. The volume traded in these instruments exceeds the volume of physical silver that can realistically be delivered by orders of magnitude. This structure works as long as most participants treat silver not as something to be taken, but as something to be traded. When confidence in that structure is stable, prices move within predictable ranges. When confidence is interrupted, even briefly, the market can reprice violently upward without any immediate change in physical reality. This is why the surge itself is not the central mystery. The real question is why such a price cannot remain. If $117 truly reflected a new, durable condition of scarcity, the market would not need to rush away from it. It would consolidate, ration demand, and slowly rebuild supply. Instead, history shows that such spikes are followed by equally dramatic retreats. The system does not absorb them, it rejects them. That rejection is not psychological, it is structural. A sustained repricing of silver to that level would propagate through far more than the precious metals sector. It would immediately alter the cost structure of electronics, energy systems, medical equipment, and a wide range of industrial processes. It would force repricing of long-term contracts. It would expose hedging books. It would stress inventories and procurement chains that are built around far lower assumptions. More importantly, it would send a signal that the monetary layer of the system is no longer anchored. Silver, despite its industrial uses, still functions as a confidence barometer. When it moves in a disorderly way, it is rarely only about silver. It is about trust in the pricing mechanism itself. From this perspective, the surge is not the event, it is the symptom. The event is the inability of the system to tolerate the implication of that price. When the price fades, it will not be because the underlying tensions have disappeared. It will be because the structure that governs modern markets has acted to restore a form of order, even if that order is artificial and temporary. This is the central tension that frames the entire episode. If silver can move to $117, it reveals that something in the system is capable of breaking. If it cannot stay there, it reveals that the system is also capable of forcing a reversion, regardless of what pressures remain underneath. The story, therefore, is not about a speculative spike. It is about a financial architecture that produces extreme signals and then suppresses their meaning. The surge announces stress. The fade announces control. And it is in the space between those two facts that the real risk to decision makers is quietly accumulating. Ever wondered how silver can skyrocket to a price that just seems impossible to hold? To understand this, you need to know a secret. Silver doesn't trade in one market, but two, and they play by completely different rules. First, you have the paper silver market. This is where the price you see on the screen is born. It's a world of futures contracts, options, and complex financial instruments. Here, silver isn't really a metal, it's a number, a ticker symbol. People are trading promises and contracts, not actual bars. Most of them never plan to touch a single ounce of physical silver. They're managing risk, hedging bets, or just trading the price swings. It's fast, it's digital, and it's massive. Then there's the physical silver market. This is the real world of mining, refining, and making things. It's where silver is an essential component in electronics, solar panels, and jewelry. This market moves at the speed of trucks, ships, and production schedules. It's governed by things like industrial demand, inventory levels, and logistics. Here, silver is a real, tangible material. Under normal conditions, these two markets stay in sync. The paper market sets a price, and the physical world uses it as a reference. The glue holding them together isn't direct delivery of metal, it's confidence. The belief that if you really needed the metal, you could get it. But here's the twist. The scale difference is staggering. The amount of paper silver traded in a single day dwarfs the amount of physical silver mined globally. For every 1 ounce of real, deliverable silver, there are many, many more claims to it on paper. As long as everyone is happy to settle their trades in cash, the system works. It's efficient and incredibly liquid. But when confidence wavers, this design becomes a huge vulnerability. A violent price surge almost always starts in the paper market. A big buyer, a sudden change in rules, or a short squeeze can send the price launching upwards. It doesn't climb, it jumps. This isn't the market discovering the true value of silver, it's the market discovering a problem on someone's balance sheet. During this chaos, the physical market is just watching from the sidelines. Mines can't instantly produce more. Refineries can't ship faster. So the screen price detaches from reality, and this is where the problem becomes clear. At an extremely high price, say $117 an ounce, the physical market puts on the brakes. Industrial users stop buying. Demand vanishes. Scrap silver starts flooding in. The price is too high for industry to pay and too unstable for physical holders to trust. It exists in a fragile financial bubble, held up only by the mechanics of the paper market. You see, the idea of the market setting one price is a myth. The paper market can print any number it wants, but the physical market can simply refuse to play along. In theory, arbitrage traders should close this gap, but in a crisis, the money and logistics to do so just aren't there. Commentators will scream shortage, but it's usually a shortage of liquidity in the paper market, not a shortage of metal in a vault. And a liquidity shortage can be fixed much faster than a real physical one. This is why the crash becomes almost inevitable. As the pressure in the paper market eases, rules change, big players back off, the price loses its support. It comes crashing back down to meet the slow, steady reality of the physical world. The physical market doesn't care about volatility, it cares about budgets and engineering plans. These two markets are linked by a fragile thread of confidence. An extreme price surge exposes that thread, and the inability to stay there proves just how conditional it is. The surge is born from financial leverage. The fall is enforced by real-world use. This fundamental split is the fault line in the silver market, and it's where every future drama will unfold. Have you ever wondered why the price of silver seems stuck, even when demand is soaring and inflation is eating away at our savings? It feels like the system is rigged, doesn't it? Well, today we're going to pull back the curtain on the great silver story, a tale of market manipulation, historical power plays, and a potential financial reset that could change everything. Let's start with the basics. Where does the price of silver actually come from? For most of the world, it's determined by two key institutions. The COMEX in New York and the London Bullion Market Association, or LBMA. Think of them as the global headquarters for precious metals trading. But here's the catch. They primarily trade in paper silver. These are futures contracts, options, and other derivatives. They represent a promise of silver, not the actual physical metal. This creates a massive disconnect between the amount of silver being traded on paper and the amount that actually exists in the vaults. This is where a tricky concept called rehypothecation comes into play. Imagine you deposit your physical silver into a vault for safekeeping. The vault then lends your silver out to someone else who might then lend it out again. This single ounce of real silver can be used as collateral for multiple loans and paper contracts. It's a house of cards built on a tiny foundation of physical metal. Let me give you a numerical example to illustrate this leverage. Let's say a vault holds 1 million ounces of physical silver. Through rehypothecation and the creation of paper derivatives, they could issue contracts representing 100 million ounces of silver. That's a leverage ratio of 100 to 1. For every 1 ounce of real physical silver they have, they've created 99 paper promises. As long as everyone trusts the paper and doesn't ask for the physical metal all at once, the system holds. But if confidence wavers, the entire structure could collapse. This is why many people say the silver price is suppressed. The sheer volume of paper silver available to be sold on the market keeps the price artificially low. Now, this isn't a new phenomenon. Let's travel back to the late 1970s and talk about the legendary Hunt brothers. The economic climate then was brutal. The U.S. was experiencing stagflation, a nasty mix of high inflation, high unemployment, and slow economic growth. Confidence in the U.S. dollar was plummeting. The Hunt brothers saw this and believed that silver, a traditional store of value, was massively undervalued. They decided to take a stand not just for profit, but against the failing fiat currency system. They started buying up enormous quantities of physical silver and futures contracts, trying to corner the market. For a while, it worked. The price of silver skyrocketed from around $6 an ounce to nearly $50. They were challenging the system, and the system did not like it. The authorities, in collaboration with the exchanges, changed the rules of the game mid-play. They limited the number of contracts one entity could hold and eventually allowed trading for liquidation only, forcing the Hunts to sell. The price crashed, and the event, famously dubbed Silver Thursday, became a cautionary tale for anyone who dared to challenge the paper market. Fast forward to today, and we're seeing a modern-day version of the Hunt brothers movement, but this time it's decentralized and global. It's not led by a few billionaires, but by millions of ordinary people in online communities. You've probably heard of them, groups on Reddit, Telegram, and other social media platforms. They call themselves silver stackers, or silver apes. They share the same belief as the Hunts, that silver is real money, and its price is being artificially suppressed by the paper markets. Their strategy is simple. Buy physical silver, 1 ounce at a time, and take it out of the system. They believe that by collectively draining the physical supply from vaults like the COMEX, they can expose the paper charade and force a true price discovery. It's a grassroots movement aiming to end the manipulation from the bottom up. This movement is gaining momentum against a backdrop of huge geopolitical shifts. We're witnessing the rise of de-dollarization. For decades, the US dollar has been the world's reserve currency. But major global powers, particularly the BRICS nations, Brazil, Russia, India, China, and South Africa, now expanded to include others, are actively working to change that. They're settling trades in their own currencies, bypassing the dollar entirely. Why? Because the dollar's dominance gives the US immense economic and political power. By creating alternative systems, these nations are challenging that dominance and hedging against the instability of the dollar. And what are they accumulating as they move away from the dollar? Gold and, increasingly, silver. And here's another huge piece of the puzzle: industrial demand. Silver isn't just money, it's a critical industrial commodity. It is the most conductive and reflective metal on the planet. This makes it indispensable for new technologies. Every solar panel needs silver. The transition to green energy is creating a massive, non-negotiable demand. And it's not just solar. Electric vehicles use significantly more silver than traditional cars, in their batteries, wiring, and countless electronic components. As the world goes green and electric, the demand for industrial silver is set to explode, putting even more pressure on an already tight physical supply. So what does all this mean for you? It means we could be heading for what many call a financial reset. This isn't some far-off theory, it's a potential reality we need to prepare for. A reset would mean the current debt-based fiat currency system, led by the US dollar, reaches its breaking point. If the dollar were to lose its reserve status, we could see rapid inflation, or even hyperinflation. The value of your cash savings could evaporate almost overnight. Your pension, your 401k, anything priced in dollars would be at risk. It would be a painful, chaotic transition. In this scenario, tangible assets, things you can physically hold, would become king. Real estate, land, and of course, precious metals like gold and silver would no longer be just investments. They would be essential tools for preserving wealth. They can't be printed out of thin air, and they have held their value for thousands of years. The story of silver is the story of real money versus paper promises. It's a clash between grassroots movements and powerful institutions, a tale of history repeating itself on a global scale. As industrial demand surges and nations turn away from the dollar, the pressure on the silver market is building. Whether you're a seasoned investor or just starting to pay attention, understanding this dynamic is crucial for navigating the uncertain economic times ahead. When the price of silver retreats from an extreme level, the dominant interpretation is almost always the same. The move is labeled a speculative excess. The reversal is treated as a return to normality. The episode is filed away as a curiosity, not a warning. This interpretation is convenient. It is also strategically misleading. In a stable system, failed breakouts do, in fact, mean that a market has tested a boundary and found no reason to cross it. In an unstable system, failed breakouts mean something very different. They mean that pressure has reached a point where it can no longer be expressed smoothly, but it is still being forcibly contained. Containment does not resolve stress. It redistributes it. The modern financial system relies heavily on this kind of redistribution. When a problem becomes too concentrated in one area, policy, liquidity, and regulation shift it elsewhere. This is often effective in the short term. It is rarely free in the long term. Each intervention changes incentives, distorts signals, and increases the system's dependence on further intervention. Silver sits at an unusual intersection of these dynamics. It is small enough to be controlled, but symbolic enough to matter. It can be pushed back into range, but the effort required to do so is itself a signal of how much force is being applied to the broader structure. This is why the fade should not be interpreted as the end of the story. It should be interpreted as evidence that the story cannot yet be told openly through prices. Repeated episodes of surge and suppression have a cumulative effect. They do not release energy, they store it. In physical systems, this process is called compression. In financial systems, it appears as growing divergence between official stability and underlying fragility. Volatility is reduced in the short term, but discontinuity risk increases in the long term. The longer a market is prevented from clearing naturally, the more violent the eventual clearing tends to be. Now, this is not a prediction about silver specifically. It is an observation about controlled systems in general. From a strategic perspective, the most important mistake decision makers can make is to treat the failed breakout as proof that nothing has changed. In reality, something has changed simply because such a breakout was possible. Prices do not attempt to escape stable structures. They attempt to escape structures that are already under strain. The forces that drove silver toward an extreme level did not disappear when the price retreated. They were countered. That is a crucial distinction. Debt levels did not fall. Monetary expansion did not reverse. Geopolitical fragmentation did not heal. Supply chains did not become simpler or more robust. Confidence did not become less necessary. All that changed was the location where the stress is currently being expressed. This is why focusing on the price of silver itself misses the strategic point. The episode is not a lesson about a metal. It is a lesson about how modern price systems behave when they are asked to transmit uncomfortable information. They transmit it briefly, and then they are forced back into silence. But silence is not the same as stability. Over time, the gap between what prices are allowed to say and what conditions actually are continues to widen. This gap does not close gradually. It closes in steps, sometimes through currency adjustments, sometimes through policy regime changes, sometimes through financial crises that reprice many assets at once rather than one at a time. In this context, silver's behavior should be read as an early warning indicator rather than a trading signal. It shows that the system is still capable of enforcing order, but only through increasing effort. It shows that price discovery is still functioning, but only within boundaries that are becoming more political and less economic. And it shows that the cost of maintaining the appearance of stability is rising. For business leaders and long-term capital allocators, the implication is not that silver should be bought or sold. The implication is that assumptions about continuity should be treated with caution. Planning in such an environment requires recognizing that reference prices, financing conditions, and policy frameworks are less durable than they appear. It requires building strategies that can tolerate regime shifts rather than merely volatility. The surge and the fade, taken together, are not a cycle. They are a signal test. They show how far the system can be pushed before it responds, and how it responds when it must. And most importantly, they show that the pressures that made such a test necessary in the first place have not been resolved. They have only been deferred. In systems built increasingly on management rather than equilibrium, deferral is not a solution. It is a countdown. The episode, therefore, should not be remembered as a failed breakout. It should be remembered as a controlled warning.